Have you ever wondered what separates successful investors from the rest? What strategies do they use to achieve remarkable results in the stock market? Well, my friends, we have the answer for you. Today, we're going to delve into the timeless wisdom of one of the greatest investment books of all time, The Intelligent Investor by Benjamin Graham. Benjamin Graham was a renowned economist and investor who mentored some of the most legendary figures in the financial world, including Warren Buffett. So grab your favorite beverage, settle into your comfiest chair, and let's unravel the secrets of intelligent investing together. Before we dive into the book, let me set the stage for you. Imagine yourself in the roaring 1920s, a time of great wealth and prosperity, but also rampant speculation in the stock market. People were chasing quick profits, and the euphoria seemed unstoppable. That is, until the stock market crashed in 1929, triggering the Great Depression. Investors were devastated, their dreams shattered overnight. It was during these turbulent times that Benjamin Graham rose to prominence, armed with a contrarian approach and a desire to find true value in the market. Chapter 1: Investment versus Speculation. Our journey begins with the very foundation of intelligent investing, the distinction between investment and speculation. Graham emphasizes the importance of approaching the stock market as an investor rather than a speculator. What's the difference, you ask? Well, an investor analyzes the underlying value of a company, its assets, and its earnings potential, while a speculator focuses on price fluctuations and short-term gains. Graham encourages us to be patient, disciplined, and focus on long-term wealth creation. Chapter 2: Mr. Market. Now let's meet Mr. Market, a fascinating character introduced by Graham. Imagine Mr. Market as a manic depressive business partner who offers you stock prices every day. Some days he's euphoric, offering sky-high prices, and on others, he's despondent, selling stocks at rock-bottom prices. Graham teaches us to approach Mr. Market with a level head, ignoring his emotional swings and relying on our own analysis and research. By doing so, we can seize opportunities when Mr. Market is irrationally pessimistic and sell when he's overly optimistic. Chapter 3: The Margin of Safety. One of the key pillars of intelligent investing is the concept of the margin of safety. Graham emphasizes the importance of buying stocks at a significant discount to their intrinsic value. By doing so, we create a buffer that protects us from unforeseen market downturns. This margin of safety ensures that even if our analysis or forecasts are slightly off, we still have a cushion that safeguards our investments. It's like buying a dollar for 50 cents. Who wouldn't want that? Chapter 4: Market Fluctuations. In this chapter, Graham tackles the unavoidable reality of market fluctuations. He highlights that market movements are not indicative of a stock's true value. Instead, he advises us to take advantage of these fluctuations by buying undervalued stocks when the market is pessimistic and selling overvalued stocks when the market is exuberant. It's all about capitalizing on the emotional swings of the market rather than being swayed by them. Graham reminds us that it's not about timing the market, but time in the market that matters. Chapter 5: The Defensive Investor and the Enterprising Investor. As we progress through the book, Graham introduces us to two distinct types of investors: the defensive investor and the enterprising investor. The defensive investor prefers a more conservative approach, focusing on low-cost index funds and a diversified portfolio. On the other hand, the enterprising investor is willing to put in the time and effort to conduct thorough research and analysis, seeking out individual stocks that offer exceptional value. Graham provides guidance for both types, emphasizing the importance of aligning one's investment strategy with their individual temperament and capabilities. Chapter 6: The Investor and Market Fluctuations. Now, here's where Graham's insights truly shine. He emphasizes that, as investors, we should view market fluctuations as opportunities rather than threats. Instead of fearing market downturns, we should embrace them as a chance to acquire quality assets at discounted prices. By maintaining a long-term perspective, and focusing on the underlying value of the companies we invest in, we can navigate through the ups and downs of the market with confidence. Chapter 7. Stock Selection for the Defensive Investor. Graham dedicates an entire chapter to provide guidance for the defensive investor when it comes to stock selection. He suggests focusing on established, financially stable companies with a consistent track record of earnings and dividends. By prioritizing companies with a strong competitive advantage and sound financials, the defensive investor can build a portfolio that withstands market volatility and generates steady returns over time. Chapter 8. The Investor and Market Fluctuations. Moving forward, Graham emphasizes the importance of conducting thorough research and analysis to uncover undervalued stocks. He introduces various financial ratios and metrics that investors can use to evaluate a company's financial health and determine its intrinsic value. By following a disciplined approach to analysis and seeking out opportunities where the market's perception differs from the company's true value, we can identify potential winners in the stock market. Chapter 9. The Investor and His Advisors. In this chapter, Graham sheds light on the relationship between investors and their advisors. He cautions against blindly following the advice of others and encourages investors to educate themselves, develop their own investment philosophy, and make informed decisions. Graham's teachings remind us that we have the power and responsibility to be active participants in our financial journey. And there you have it, fellow investors, a glimpse into the invaluable wisdom of The Intelligent Investor by Benjamin Graham. This timeless masterpiece has shaped the investment strategies of countless successful investors throughout history. Graham's principles of value investing, margin of safety, and long-term thinking continue to guide investors even in today's ever-changing market. Remember, investing is not a quick sprint, it's a marathon. By following Graham's teachings and adopting an intelligent and patient approach to investing, we can strive to achieve our financial goals and build a more secure future. With that said, thanks for watching, and until next time, happy investing.